Okay, so we're gonna talk about point number 3 of the 5 areas that you should talk to your accountant after your tax filing for the current tax year. Okay, so point number 3 is that you should have received some recommendations and a plan for your tax refund if you receive some. Okay, so there could be 20, 30 different areas where there's recommendations, or 50 even. I'm gonna talk about 5 today, and maybe in a different video we can come up with 20 or 30 different ideas. But here's 5 that I do often see. Okay, so the first one is allocation of RRSP contributions. So if there are 2 spouses contributing to an RRSP, we instantly look at which tax brackets those spouses are in. If you are in a different tax bracket than your spouse and you're both contributing, you should reallocate where the contributions are going. If you allocate everything to the higher income earner, you're going to get a larger tax refund. So that's one thing that your accountant should be talking to you about after you're filing for the upcoming year. The second point that I often see has to do with childcare. So if you are childcare and are a self-employed person taking dividend income, you really need to understand how childcare expenses work. So first of all, childcare expenses has to be claimed by the lower income earner. As well, they cannot be claimed against dividend income. So what we absolutely don't want to see is the lower income earner taking 100% dividend income, because you virtually cannot claim any of those childcare expenses. So if you did and you made the mistake, you need to be told for the upcoming year how to correct this, because there is a solution. There's 2 things that you can do. Either the dividend income earner has to increase income above the T4 income earner, so the other spouse, or you restructure the type of income that you're taking from your corporation. So instead of dividends, make sure that you're taking enough T4 income if you're the lower income earner and can't get above your spouse, so that you're able to claim the whole childcare expense. Another idea has to do with labor-sponsored funds. So the labor-sponsored fund, in summary, provides you with a tax deduction, a federal credit, and a provincial credit. What I often see is that a person buys a labor fund just because they're not fully, they don't know their full tax situation for the year. So you buy your labor fund before you file your taxes. So we always are reviewing how much provincial tax you have owing. So if you do not fully utilize your provincial credit, if you're buying a labor fund, we always make you aware. You should be made aware for the following tax year. Doesn't mean that it doesn't make sense to buy, but you need to understand why you're buying it. Some people just still want the tax breaks that they're going to get from the federal credit, and some people just would not buy the labor fund because they would prefer to invest in a different type of investment. So if you are buying a labor fund and you're not paying provincial tax or not paying enough provincial tax to fully utilize that credit, you need to be made aware. Okay, so the next point is with charitable donations. This isn't a big, needle, but it's good to be made aware, and it's good for your accountant to bring this up. So the first $200 of contribution is at a 15% credit rate on the federal side, and then 29% above that first $200. The other thing is that you don't have to claim all of the donations in the current tax year. So normally what happens, you give your receipts, they get claimed, and we don't talk about it. So what we want to have happen is that if we notice that you aren't above that 200 or you're hovering the 200, it may make sense to not claim the charitable donation this year and have it accumulate a little bit. Again, it's not a huge tax saver, but it's good. You need to be made aware. And then the decision is do you want the tax break now, or do you want to, delay it for a different tax year? The last point as well has to do with RRSPs. So most people will contribute to an RRSP, they give everything to their accountant, and then everything gets claimed. Well, just because you contributed to your RRSP this tax year doesn't mean you have to claim the full amount. So what you and your accountant need to talk about is maybe you only utilize part of the RRSP to bring you down to the next tax bracket, and then you carry forward the balance into the following tax year. So this might make sense for tax savings over 2 years, but you should talk about what you want to accomplish. Maybe you need the tax break now, you want the money in your pocket because you got something else that you want to pay down debt. But you just need to be aware of if you want to be carrying that forward to a different tax year. You don't even need to utilize any of it in the current tax year. So that's the planning that we want to do. So there's 5 ideas out of 20, 30, 50 different ideas that we see. And then the other thing to note is the plan for the upcoming tax refund. Now, in all reality, it is not your accountant's job to plan what you are going to do with your tax refund. But this is where we're a bit special. Because we have a full financial plan in place, we essentially know where we want to allocate those tax refunds. When we first meet our clients, most people just end up not really having a firm plan with their tax refunds, and it gets lost in the midst of the cash flow that they have. We, after working with them on a full financial plan and doing their taxes, have a firm plan with tax refunds. And for many of our clients, we're allocating a portion of it as a prepayment on their mortgage and other debt possibly if they have. And we know if we're going to allocate extra tax refund towards next year's RRSP contribution, we usually put a portion to a education savings plan so we can get extra grant, and then some into a TFSA. So it's well planned out, and it's usually diversified so that we're hitting every different area of a person's goal. So that's point number 3 in what you should be talking to your accountant about after you receive your tax filing.